Rachel Reeves is pressing your pensions and stocks and shares ISAs into the service of the UK economy. And there's not much you can do about it. In a desperate bid to generate growth and save her own reputation, Reeves is preparing to tell ordinary investors where to put their money. Instead of leaving that decision down to you, she wants to direct tens of billions of our savings into areas that suit her. Stay informed with the latest UK news. Subscribe to Brit News Pulse for breaking headlines, expert analysis, and in-depth reports on politics, finance, and current affairs. Hit the subscribe button now and never miss an update. The Chancellor is quietly rewriting the rules of the game, treating your hard-earned savings not as private investments but as tools of government policy. You may think that your pensions and ISAs belong to you. Reeves appears to disagree. She needs growth, fast. And she's coming for your money to get it. Thanks to her own blunders, the Chancellor is in a tight spot. She caved into the Labour Party's worst instincts by launching a £40 billion tax raid in last October's budget, while borrowing another £30 billion. And it's all gone wrong. Economic growth has flatlined. Investment has dried up. Confidence is low. Thanks to her, jobs tax, unemployment has climbed to a 4-year high. Reeves is now desperately hunting for ways to get the UK economy to grow again, and this is where your pensions and ISAs come into it. She's hijacking them to fund her growth agenda and salvage her reputation. That money should be working for your future, not hers. Reports suggest Reeves is considering forcing stocks and shares ISA investors to back UK companies, whether they want to or not. She may slash the cash ISA allowance and make at least some of the £20,000 stocks and shares ISA allowance conditional on investing in British listed equities. ISA tax relief costs the Treasury £9.4 billion a year. Reeves wants a better return on that giveaway. Second, she's now signed up 17 major pension providers via the controversial Mansion House Accord. They will funnel £25 billion into UK projects like housing and infrastructure and renewable energy, often by investing in smaller, unquoted companies. Which, as far as I can gather, the government might even help choose. She could go further. Former Pensions Minister Ross Altman is urging Reeves to link tax relief on pension contributions to investing in UK plc. Pensions tax relief costs the Treasury a staggering £70 billion a year. Altman urged Reeves to demand at least 25% of that goes into UK shares. As yet, I don't know if Reeves will listen. But Altman's idea would be consistent with the first two proposals. To be fair, there is logic here. If the government is giving tax breaks, it probably does have the right to expect something in return. Personal equity plans, or PEPs, the forerunner of today's ISAs, were largely limited to UK shares and nobody complained too much then. But it does allow Reeves to play industrial strategist with other people's money. It's a dangerous precedent that could ultimately leave savers worse off. Reeves is also blurring the line between private investment and public subsidy. Your pension or stocks and shares ISA isn't the Chancellor's war chest. It exists to fund your retirement, not to rescue the British stock market or her career. If your money can do better invested in US shares, and lately it has done better, a lot, then that's where it should be. British investors diversify globally for one reason, to get superior returns. Forcing them back into British assets risks leaving them poorer. Worse, politically motivated investing often leads to disaster. From green infrastructure to social impact projects, high-minded schemes have delivered disappointing results lately. But these are exactly the kind of ventures Labour is likely to champion. One lone voice has raised the alarm. Scottish widows refused to sign the Mansion House Accord, warning that investment decisions should be based on returns, not geography. It's right. This may be Reeves' only big idea for growth. But if it goes wrong, it won't be her pension that pays the price. Thanks for tuning in. If you found this video valuable, smash that subscribe button and turn on notifications so you never miss out on top-tier content. Your thoughts matter, drop a comment below and let's keep the conversation alive. See you in the next one.